Hey everyone, what's up? Welcome back to the channel. I'm talking about building your freedom blueprint, the Freedom Builders Blueprint. From paycheck to financial freedom. Are you tired of the endless cycle of working for a paycheck only to see it disappear on bills and expenses? What if you could break free from this cycle and build a life where your money works for you? The Freedom Builder's Blueprint reveals how to transform your financial life through a fundamental mindset shift and practical, actionable strategies. This book guides you on a journey from being dependent on a salary to achieving true financial independence. It begins by challenging you to see your paycheck not as a reward to be spent, but as seed capital to be planted. This crucial mindset shift is the foundation for everything that follows. You'll learn to pay yourself first, automate your savings, and distinguish between needs and wants, creating a growing gap between what you earn and what you spend. But changing your behavior isn't enough. You must also confront and rewrite the hidden beliefs about money that hold you back. Through practical exercises, you'll identify and overcome scarcity thinking, fear of risk, and self-limiting identities that keep you stuck in the employee mindset. Real transformation occurs when you start thinking like an owner, even while you're still employed. You'll discover how to leverage your current job as a strategic platform, using it to fund your investments, gain valuable knowledge, and build a network that will support your future ventures. The Freedom Builders Blueprint then guides you through the practical steps of building wealth. You'll learn how to make your first investment with confidence, create an automated system that grows your money consistently, and develop the psychological resilience to navigate market ups and downs without panic or greed driving your decisions. This isn't about get-rich-quick schemes or complex financial formulas. It's about building a sustainable system that gradually shifts you from active income to passive income. Each chapter provides clear principles and actionable steps that compound over time, much like the investments you'll be making. Your journey culminates in more than just financial security. It leads to true freedom. The freedom to choose how you spend your time, the freedom to pursue work that matters to you, and the freedom to leave a legacy that extends beyond your lifetime. The path from employee to investor begins with a single decision to see your financial life differently. The Freedom Builders Blueprint gives you the tools, strategies, and mindset to make that journey successfully. Your future of financial freedom starts not with more money, but with a new perspective. The blueprint is here. The choice is yours. The book is structured into 10 chapters, each focusing on a key theme. Not the harvest. Chapter 1. Your paycheck is a seed. Not the harvest. Your paycheck is not a finish line. It is a starting point. Most people treat their salary as the end goal of their work, a reward to be spent. This mindset creates a cycle of Chapter 1. Your paycheck is a seed. Not the harvest. Chapter 1. Your paycheck is a seed. Your paycheck is not a finish line. It is a starting point. Most people treat their salary as the end goal of their work, a reward to be spent. This mindset creates a cycle of trading time for money, then money for expenses, with nothing left to build a future. The fundamental shift from employee to investor begins by redefining your paycheck. See it not as income to consume, but as capital to plant. It is a seed. A wise farmer never eats all their harvest. They save the best seeds to plant for a larger future crop. Your financial freedom is that future crop. To pay yourself first principle. The most powerful habit you can build is to pay your future self first, before paying any bills or expenses. Automatically divert a portion of your paycheck aim for at least 10 to 20% into a separate savings or investment account. Tease is not about what remains after spending. It is about prioritizing your future before your present wants. This single habit forces financial discipline and ensures your wealth grows steadily with every pay cycle. Mastering needs versus wants. 2. Make pay yourself first sustainable. You must clearly distinguish between needs, essentials for survival and basic well-being, housing, food, utilities. Wants, known essentials that enhance lifestyle, dining out, entertainment, luxury items. Most people unconsciously upgrade their lifestyle as their income rises, spending more on wants while their savings rate stays the same. This lifestyle inflation is the enemy of wealth building. The gap between what you earn and what you spend is your freedom fund. Protect it. Your mind is your best investment. The first place to invest your seed capital is often in yourself. Use part of your paycheck to acquire new skills, knowledge, or certifications. This investment in your human capital increases your earning potential, which in turn provides more capital for future investments. This psychological shift, this approach, requires a employee mindset. I work to earn, and I earn to spend. Investor mindset. I work to gather resources to build. When you see your paycheck as seed capital, your job transforms. It is no longer just a source of income, but a platform for gathering the resources needed to build your independence. You stop being a passive consumer of your income and become the active architect. The journey to financial freedom begins with this single decision: to treat your paycheck not as a reward to be consumed, but as a seed to be planted. Every dollar you save and invest is a vote for your future freedom. Time for money, then money for expenses. Investor begins by redefining your paycheck. See it not as income to consume, but as capital to plant. It is a seed. A wise farmer never eats all their harvest. They save the best seeds to plant for a larger future crop. Your financial freedom is that future crop. Pay yourself first. Principle tit. Most powerful habit you can build is to pay your future self first. Before paying any bills or expenses, automatically divert a portion of your paycheck aim for at least 10 to 20% into a separate savings or investment account. Tease is not about what remains after spending. It is about prioritizing your future before your present wants. This single habit forces financial discipline and ensures your wealth grows steadily with every pay cycle. Your paycheck is not a finish line. It is a starting point. Most people treat their salary as the end goal of their work, a reward to be spent. This mindset creates a cycle of Chapter 1. Your paycheck is a seed, not the harvest. Your paycheck is not a finish line. It is a starting point. Most people treat their salary as the end goal of their work, a reward to be spent. This mindset creates a cycle of trading time for money, then money for expenses, with nothing left to build a future. The fundamental shift from employee to investor begins by redefining your paycheck. See it not as income to consume, but as capital to plant. It is a seed. A wise farmer never eats all their harvest. They save the best seeds to plant for a larger future crop. Your financial freedom is that future crop. Pay yourself first. Principle. The most powerful habit you can build is to pay your future self first before paying any bills or expenses. Automatically divert a portion of your paycheck aim for at least 10 to 20% into a separate savings or investment account. This is not about what remains after spending. It is about prioritizing your future before your present wants. This single habit forces financial discipline and ensures your wealth grows steadily. Mastering needs versus pay yourself first. Sustainable. You must clearly distinguish between needs, survival, and basic well-being: housing, food, utilities; wants, non-essentials that enhance lifestyle, dining out, entertainment, luxury items. Most people unconsciously upgrade their lifestyle as their income rises, spending more on wants while their savings rate stays the same. This lifestyle inflation is the enemy of wealth building. The gap between what you earn and what you spend is your freedom fund. Protect it. Your mind is your best investment. The first place to invest your seed capital is often in yourself. Use part of your paycheck to acquire new skills, knowledge, or certifications. This investment in your human capital increases your earning potential, which in turn provides more. The psychological shift, TIS approach, requires a complete mindset change. Employee mindset: I work to earn, and I earn to spend. Investor mindset: I work to gather resources, and I use those resources to build. When you see your paycheck as seed capital, your job transforms. It is no longer just a source of income, but a platform for gathering the resources needed to build your independence. You stop being a passive consumer of your income and become the active architect of your financial future. The journey to financial freedom begins with this single decision: to treat your paycheck not as a reward to be consumed, but as a seed to be planted. Every dollar you save and invest is a vote for your future freedom. Time for money, then money for expenses. with nothing left to build a future. The fundamental shift from employee or paycheck. See it not as income to consume, but as capital to plant. It is a seed. A wise farmer never eats all their harvest. They save the best seeds to plant for a larger future crop. Your financial freedom is that future crop. The pay yourself first principle. The most powerful habit you can build is to pay your future self first. Before paying any bills or expenses, automatically divert a portion of your paycheck aim for at least 10 to 20% into a separate savings or investment account. Tease is not about what remains after spending. It is about prioritizing your future before your present wants. This single habit forces financial discipline and ensures your wealth grows steadily with every pay cycle. Mastering needs versus wants to make pay yourself first sustainable. You must clearly distinguish between needs, essentials for survival, and basic well-being: housing, food, utilities. Wants, non-essentials that enhance lifestyle: dining out, entertainment, luxury items. Most people unconsciously upgrade their lifestyle as their income rises, spending more on wants while their savings rate stays the same. This lifestyle inflation is the enemy of wealth building. The gap between what you earn and what you spend is your freedom fund. Protect it. Your mind is your best investment. First place to invest your seed capital is often in yourself. Use part of your paycheck to acquire new skills, knowledge, or certifications. This investment in your human capital increases your earning potential, which in turn provides more capital for future investments. The psychological shifties approach requires a complete mindset change. Employee mindset, and I earn to spend. Investor mindset, I work to gather resources, and I use those resources to build. When you see your paycheck as seed capital, your job transforms. It is no longer just a source of income, but a platform for gathering the resources needed to build your independence. You stop being a passive consumer of your income and become the active architect of your financial future. The journey to financial freedom begins with this single decision: to treat your paycheck not as a reward to be consumed, but as a seed to be planted. Every dollar you save and invest is a vote for your future freedom. Chapter 2. The Invisible Prison. Rewriting your money mindset before you can build external wealth. You must first dismantle the internal prison holding you back. The walls of this prison are made of brick and mortar. They reconstructed from limiting beliefs, unconscious assumptions, and inherited stories about money that dictate your financial reality. Most people never question these mental models. They accept them as truth, never realizing that living within boundaries created by others' experiences and fears. This chapter will help you identify your financial programming and rewrite it for success. The architecture of limiting beliefs. Your money mindset was constructed piece by piece throughout your life. Consider these common phrases you might have heard growing up. Money doesn't grow on trees. We can't afford that. Rich people are greedy. Be practical, not ambitious. While often well-intentioned, these messages program a mindset of scarcity, limitation, and moral judgment around wealth. They create subconscious associations that wanting more is somehow wrong, or that financial success requires moral compromise. The 4 mental shifts required to escape this mental prison you must make for crucial mindset shifts. 1. From scarcity to abundance. The scarcity mindset believes money is a finite pie. If someone else gets a bigger slice, you get less. This creates hoarding behavior, risk aversion, and jealousy of others' success. The abundance mindset understands that wealth can be created, that opportunities are infinite, and that others' success doesn't diminish your potential. This fosters collaboration, creativity, and smart risk-taking. Practical shift. Catch yourself every time you think I can't afford that, and replace it with how can I afford that. This moves you from passive victim to active problem solver. 2. From fixed to growth. The fixed mindset believes your financial capabilities are set in stone. You're either good with money or you're not. This leads to avoiding financial education and giving up when facing money challenges. The growth mindset knows that financial intelligence can be developed through study and practice. Every financial mistake becomes a learning opportunity, not a personal failure. Practical shift. Replace "I am bad with money" with "I am learning to master money management." 3. From employee to investor. Thinking. The employee mindset focuses on linear income, trading hours for dollars. The primary question is, how can I earn more per hour? The investor mindset focuses on assets and systems. The primary question becomes, how can I put my money to work creating more money? Practical shift. Start asking, what can this money create, rather than what can this money buy? 4. From security to freedom. The security mindset prioritizes safety above all else. It chooses the predictable paycheck over the uncertain opportunity, even when that opportunity offers far greater potential. The freedom mindset understands that true security comes from developing skills, building assets, and creating options, not from clinging to a single job or income source. Practical shift. When facing a decision, ask which choice creates more future options, rather than which choice feels safer right now. Confronting your financial identity. One of the most powerful limiting beliefs is the story you tell yourself about who you are financially. Saying, "I am just not good with numbers," or "I am not a business person" is a statement of fact. It is an identity you've adopted that becomes a self-fulfilling prophecy. You must separate your current financial reality from your potential. Your bank balance reflects your past decisions and beliefs, not your future capabilities. Your job title describes what you do, not who you can become. Rewiring your mental software here. As your practical action plan for rebuilding your money mindset. 1. Awareness. Audit. For 1 week, carry a small notebook and write down every money-related thought that arises. Don't judge them, just observe. You'll discover your unconscious financial programming. 2. Trace the origin. For each limiting belief, ask, where did this come from? Was it a parent's struggle? A teacher's comment? Media messaging. Understanding the source helps you realize these aren't your truths. They're inherited programming. 3. Create new mantras. For every limiting belief, write a new, empowering alternative. If you often think money is hard to come by, your new mantra becomes "Money flows to me easily when I provide value." 4. Environmental reshaping. Your environment reinforces your mindset. Clean up your financial inputs. Unsubscribe from fear-based financial media. Reduce time with chronically negative people, and add positive influences like financial education, podcasts, and books. 5. Visualize your future self. Spend 5 minutes daily vividly imagining yourself as the financially successful person you want to become. What decisions do they make? How do they think about money? What do they believe is possible? This isn't wishful thinking, it's neurological programming. The freedom of mental sovereignty. The most valuable financial asset you'll ever develop is in your bank account. It's between your ears. When you take control of your financial mindset, you stop being a passive product of your conditioning and become the conscious creator of your economic reality. This work isn't glamorous. No one will see you doing it. There are no quick results to post on social media. But this internal foundation will determine whether you build a financial house of straw, sticks, or brick, one that can withstand the inevitable wolves of market downturns, career changes, and life surprises. Your beliefs about money have been built over decades. Rewriting them takes consistent effort, but each limiting belief you identify and replace is another bar removed from your invisible prison. The process is simple, though not always easy. Notice the thought. Question its truth. Choose a better thought. The journey to financial freedom begins not with your first investment, but with your first conscious thought about money. Master your mind, and the money will follow. Chapter 3. Think like an owner, even when you're not 1T. Single greatest differentiator between an employee and an investor is on the size of their bank. Account it as the architecture of their thinking. An employee thinks like a tenant, an investor thinks like an owner. A tenant worries about monthly rent and asks, "What will the landlord fix for me?" An owner thinks about long-term value and asks, "How can I improve this property?" You don't need a title or a business to think like an owner. This mindset is a choice you can make today, and it will fundamentally reshape your career, your finances, and your future. Day ownership mindset. A practical framework. Ownership is not a vague concept. It manifests in specific, observable behaviors and thought patterns that you can immediately adopt. Uno, focus on results, not hours. Employee mindset. I deserve my paycheck. Owner mindset. I achieved the key result that moves the business forward. I created value. Owners understand that time is a resource, but value is the product. They are relentlessly focused on outcomes. In your current role, stop counting the clock and start asking, what is the most valuable thing I can accomplish today? This shift alone will make you indispensable. Don't solve problems you haven't been asked to solve. Employees wait for instructions. Owners identify problems and create solutions before being told. Look around your organization. What inefficiencies do you see? What customer pain points are being ignored? What process could be improved? Document the problem, develop a solution, and present it. Even if your idea isn't implemented, you've demonstrated crucial ownership thinking that gets noticed. Just take radical responsibility. Owners don't blame circumstances, the economy, or other people. They ask, what could I have done differently? And what's within my control right now? This isn't about accepting unfair blame. It's about reclaiming your power to affect change. When you take full responsibility for your results, you stop being a victim of your environment and start being the architect of your experience. 4. Invest in assets, not host income. Employee thinking. How can I get a raise? Owner thinking. How can I use my current income to build assets that generate future income? While employees focus on linear income growth, exchanging more time for more money, owners focus on building systems that work for them. This could mean using part of your paycheck to acquire income-producing assets, developing a side business that can eventually scale, creating digital products that earn while you sleep. 5. Build your personal board of directors. No successful owner operates in a vacuum. They surround themselves with advisors, a board of directors for their life and career. You can do the same. A mentor who's where you want to be. A peer at your level who challenges you. Approche. You can teach. Teaching solidifies learning. An industry connector who knows everyone. A skillful critic who gives honest feedback. Day 3. Ownership shifts. To make this practical, focus on making these 3 shifts in your daily work. Uno, from that's not my job to I'll figure it out. When you encounter something outside your job description, see it as an opportunity to learn and contribute rather than a burden to avoid. The most valuable skills are often learned when solving problems nobody asked you to solve. Those from I hope I get a raise to I will make myself more valuable instead of hoping for recognition. Focus on systematically increasing your value. Learn new skills that are in high demand. Take on projects that visibility and impact. Solve expensive problems for your organization. Dress from this is my job to this is my platform. Say your current position not as a destination, but as a platform for learning, building relationships, and gathering resources. Every project is practice for when you'll be running your own show. Every colleague is a potential future business connection. Every challenge is preparation for greater responsibilities. The ownership test. Ask yourself these questions regularly to gauge your progress. If this were my company, would I make the same decision I'm making right now? Am I investing my time in activities that create long-term value or just fulfill short-term obligations? What systems can I create today that will save me time tomorrow? Who can I help succeed that might help me succeed later? Building your ownership muscle starts small, but start today. Take full ownership of one project at work. Identify and solve one small problem nobody has addressed. Learn one new skill each month that increases your value. Allocate a fixed percentage of your income to asset building. Remember, ownership isn't something you're given, it's something you take. It's a mindset that says, I am responsible for my results, my learning, and my future. When you start thinking like an owner long before you are one, you don't just prepare for freedom, you begin living it right now. Their world is filled with employees waiting for permission to be great. Owners don't wait for permission. They take responsibility. And in that simple act, they separate themselves from the crowd and step onto the path to true financial independence. Chapter 4. The Launchpad Strategy. Using your job to build your escape plan. Your job is not the destination. It is the launchpad. Most people view their employment as either a prison to escape or a comfortable nest to settle into forever. Both perspectives are flawed. The strategic view recognizes your job as the single most powerful tool available for building financial independence. This chapter is your practical guide to transforming your 9-to-5 from a constraint into the very engine of your freedom. 4 pillars of strategic employment to leverage your job effectively. You must systematically exploit these 4 pillars. 1. The capital engine. Fueling your freedom fund. Your primary objective is to convert active income, your salary, into passive income-generating assets. Your job is the most reliable fuel source for this conversion. Paycheck automation. Implement to pay yourself first principle with military precision. Set up an automatic transfer that moves a predetermined percentage. Target 20 to 30% of your net pay into your Freedom Fund investment account the day your salary arrives. This money becomes invisible to your spending habits. Lifestyle inflation defense. When you receive a raise, bonus, or promotion, your default response should not be consumption. The strategic move is to immediately channel at least 80% of that new income into your investment accounts. This dramatically accelerates your timeline without requiring a drop in your current living standards. The tracking imperative. You cannot manage what you do not measure. For 1 month, track every single expense. This financial audit will reveal hidden leaks and unconscious spending patterns. The margin you create between your earnings and spending is your freedom velocity. Thus, the knowledge incubator. Getting paid to learn. You are receiving a salary while gaining a free education in business, industry dynamics, and professional skills. This is an unparalleled advantage. Learn the business model. Go beyond your job description. Understand how your company truly operates, its profit margins, customer acquisition costs, key revenue drivers, and biggest operational challenges. This knowledge is direct insight into how successful businesses work. Skill arbitrage. Identify high-value, transferable skills you can acquire: analysis, project management, public speaking, sales. Specific software. Master then on the company's dime. These skills compound your value, whether you stay or leave. Problem-solving gym. Volunteer for cross-functional projects and complex challenges. These high-visibility tasks are where the most valuable learning and professional recognition occur. 3. The network multiplier. Building strategic alliances. Your colleagues, clients, and suppliers represent a curated professional network. This is social capital you can't easily replicate elsewhere. Relationship banking. Build a reputation as reliable, competent, and generous. The strong professional relationships you nurture today can evolve into future business partnerships, client referrals, or investment leads. Mentor mining. Identify and learn from the most talented people around you. Ask thoughtful questions. Most accomplished professionals are willing to share wisdom with curious, ambitious junior colleagues. Reputation capital. Your professional brand is a permanent asset. Be known for integrity, delivering results, and elevating those around you. This reputation will open doors long after you've moved on. 4. The credibility shield. Fortifying your financial foundation. A stable job provides more than just income. It creates financial credibility that unlocks larger opportunities. Creditworthiness. Consistent employment and documented income make you eligible for mortgages and business loans at favorable rates. This leverage is critical for acquiring appreciable assets, like real estate. Proof of concept. Success in your role provides tangible evidence that you can deliver value, manage complexity, and operate within systems. This track record builds the confidence needed to launch your own ventures and convinces others to back you. The strategic exit framework. Your employment has an expiration date. The goal is to choose that date yourself, on your terms. 1. Define your walkaway number. Calculate the specific amount of monthly passive income you need to cover your essential living expenses. This is your initial financial freedom target. Those create transition triggers. Establish predefined milestones. Example: when my passive income consistently covers 75% of my expenses for 6 consecutive months, I will reduce to part-time work or transition to consulting. 3. To risk the jump. Use the stability of your job to make your initial investment mistakes. Learn with play money while your primary income remains secure. The goal is a gradual, confident transition, not a reckless leap. Conclusion: your job is your first and best investor. Reframe your relationship with your work. You are not an employee. You are the CEO of your own life, and your job is your first major investor. It is providing the essential seed capital, industry knowledge, and professional network you need to build your empire. Stop viewing your job as a limitation. Start executing the Launchpad strategy. Maximize every paycheck for capital, every project for knowledge, every interaction for network, and every success for credibility. Your path to freedom doesn't start after you quit your job. It starts by using your job with ruthless intention today. Chapter 5. The Architecture of Assets. Building your wealth foundation. Wealth is not measured by the size of your paycheck, but by the quality and quantity of your assets. This chapter moves from theory to practice, providing a clear framework for understanding, selecting, and acquiring the assets that will generate your financial freedom. What truly is an asset? An asset is not merely something you own. It is something that puts money into your pocket, whether you are working or not. This crucial distinction separates wealth-building possessions from wealth-draining liabilities. Asset: a rental property generating positive cash flow. Dividend-paying stocks: a profitable business you don't operate daily. Liability: your primary residence. It costs money in mortgage, taxes, maintenance. A car that depreciates. Consumer goods. The goal is to systematically convert your income, active money, into a growing collection of assets, passive money generators. The 4 quadrants of a healthy asset portfolio. A robust financial foundation is built on diversification across 4 key asset categories. Each serves a distinct purpose in your wealth-building engine. 1. Ownership assets. Equities. These represent owning a piece of a productive enterprise. What they are: stocks, index funds, ETFs, ownership in private businesses. Primary return driver: capital appreciation, growth in value, and sometimes dividends. Your strategy: start with low-cost broad market index funds, for example, S&P 500 ETF, for instant diversification. This is your foundation for long-term, high-potential growth. 2. Lending assets. Fixed income. These represent you acting as the bank. What they are: bonds, peer-to-peer lending, high-yield savings accounts, certificates of deposit CDs. Primary return driver: interest payments. Your strategy: use these for capital preservation and stable income. They are typically lower risk and lower return than equities, useful for your emergency fund and shorter-term goals. 3. Real assets. Tangible property. These are physical assets with inherent value. What they are: real estate, residential, commercial, commodities, gold, silver, farmland. Primary return driver: income, rent, appreciation, and inflation hedging. Your strategy: real estate is the most accessible for individual investors. Consider a house hack living in one unit of a multifamily property you own as a powerful entry point. 4. Personal assets. Your human capital. This is the most overlooked yet most critical asset class. What they are: your skills, knowledge, education, and professional network. Primary return driver: increased earning power, which provides more capital to invest in the other 3 quadrants. Your strategy: dedicate a portion of your time and income to continuous learning and skill acquisition. This asset has the highest potential return on investment. The asset acquisition funnel, a step-by-step process. Building your portfolio is a systematic process, not a random act. Stage 1. The foundation months, 0 to 6. Step 1. Emergency fund. Before any investing, secure trace 6 months of essential expenses in a high-yield savings account, a lending asset. This is your financial shock absorber. Step 2. Debt elimination. Aggressively paid down high-interest consumer debt credit cards. This is a guaranteed return on your money, equivalent to the interest rate you're avoiding. Step 3. First steps. Begin automated monthly contributions to a broad market index fund, an ownership asset. Stage 2. The growth phase, years 1 to 5. Step 4. Tax-advantaged accounts. Maximize contributions to retirement accounts like a 401k or IRA. The tax benefits supercharge your compounding. Step 5. Diversification. As your capital grows, begin allocating to other quadrants. This may include exploring real estate crowdfunding or purchasing a rental property real asset. Stage 3. The cash flow phase. Years 5 plus 6. Income focus. Shift your acquisition strategy toward assets that generate strong, predictable cash flow. The goal is for this passive income to eventually surpass your active expenses. Evaluating any potential investment. The 3 lenses before committing capital. Analyze every opportunity through these 3 filters. 1. Cash flow. Does it put money in your pocket regularly and predictably? For example, rent, dividends. 2. Appreciation. What is the potential for the underlying asset to increase in value over time? For example, stock price growth, property value increase. 3. Leverage. Can you use other people's money, like a mortgage, to control a larger asset and amplify your returns? The best assets score highly on at least 2 of these 3 lenses. Conclusion. You are a chief investment officer. You are now the CIO of your life. Your job is to allocate the capital generated from your labor into a diversified portfolio of high-quality assets. This is not a hobby. It is the core function of your financial freedom plan. Start with the foundation. Build your emergency fund, eliminate bad debt, and automate your investment in simple, low-cost index funds. As your knowledge and capital grow, strategically expand into other asset quadrants. With every asset you acquire, you are not just buying a stock or a property, you are purchasing a piece of your future freedom. Your portfolio is not a collection of ticker symbols. It is your escape plan, built 1 brick at a time. Chapter 6. The action threshold. Making your first investment. Knowledge without action is merely entertainment. This chapter bridges the gap between understanding investment theory and taking your first tangible step. The greatest obstacle to wealth building is not a lack of capital, but the paralysis of perfectionism and fear. Here, we dismantle those barriers and build a simple, actionable bridge to your future. The psychology of the first step. Your brain is wired to avoid risk, a trait that once kept us safe from predators, but now keeps us safe from prosperity. The perfectionism trap tells you that you must know everything before you begin. This is allie. The most successful investors began with less knowledge and more uncertainty than you likely have right now. The goal of your first investment is not to get rich. It is to become an investor. The 3 pillars of your first investment. Before you click buy, establish these 3 non-negotiable foundations. 1. The protected foundation. Your emergency fund of 3 to 6 months' expenses must be secure in a high-yield savings account. This is your financial buffer. It ensures that a sudden car repair or medical bill does not force you to sell your first investments at a loss. This fund is not part of your investment capital. It is the moat around your castle. Does the automatic engine. You have already automated your savings. The money you are about to invest should be invisible money that you never factor into your monthly spending. This psychologically separates your security from your speculation and turns investing from a sporadic act into a systematic process. 3. The student mindset. Acknowledge that you will make mistakes. Your first investment plan will not be your last. Embrace this. The cost of your initial, small mistakes is the tuition fee for your financial education, infinitely cheaper than the cost of inaction. Your first investment, a practical blueprint. Follow this step-by-step guide to place your first trade with confidence. Step 1. Choose your battlefield. The account you need a brokerage account. For 99% of first-time investors, the best choice is an online discount brokerage known for its low fees and user-friendly platform, for example, Vanguard, Fidelity, or Charles Schwab. Open a general investment account or, if you have earned income, a Roth IRA, which offers powerful tax-free growth. Step 2. Select your weapon. The asset complexity is the enemy of execution. Your first investment should be singular and simple. A broad market index fund, ETF. What it is: an ETF exchange-traded fund that tracks a major index like the S&P 500, for example, VU or S. When you buy one share, you instantly own a tiny piece of 500 of America's largest companies. Why it's perfect for beginners: instant diversification. You are not betting on one company, but on the entire U.S. economy. Low cost, fees-expense ratios are minimal, so more of your money stays invested. Passive management. It runs on autopilot. You don't need to analyze individual companies. Liquidity. You can buy and sell it as easily as a stock. Step 3. Execute the mission. The buy order. Log into your new brokerage account. Fund it with your predetermined amount, for example, $500. Search for the ticker symbol of your chosen ETF, for example, V. When placing the order, select Market Order for a simple, immediate purchase at the current price. Click Confirm. You are now an investor. The mystifying, the process, order types, and strategy. Market order. Buy this now at whatever the current price is. Use this for simplicity. Limit order. Only buy this if the price drops to $X or lower. Slightly more control, but your order may not execute. For your first dozen investments, a market order is perfectly fine. Your strategy is not to time the market, but to get into the market. The most powerful force in finance, compound interest. Your initial $500 is not just $500. It is a seed. Compound interest is the sunlight and rain that makes it grow exponentially. It is the process where your earnings begin to generate their own earnings. Example: you invest $500 and it earns a conservative 7% annual return. Year 1. Your $500 grows to $535, $35 profit. Year 2, you earn 7% on the new total of $535, which is $37.45. Year 10, that initial $500 could be worth nearly $1,000 without you adding another dime. Imagine you add $200 every single month to your investment. The growth becomes not a straight line, but an accelerating curve. Time is the magic ingredient. Starting now with a small amount is infinitely more powerful than starting later with a large one. Your new rhythm, the investor's habit. Your first trade is not a one-time event. It is the initiation of a new habit. The rhythm is simple. Automate. Your savings flow automatically into your brokerage account. Those execute. Once a month, log in and buy another share of your chosen ETF. Ignore. Close the app. Do not check the price daily. Your job is to consistently plant seeds, not dig them up to see if they're growing. Conclusion: the threshold is crossed. The chasm between being someone who wants to invest and someone who does invest is wide. But the bridge is simple. By focusing on a single, diversified ETF and executing a simple buy order, you cross that chasm. Do not overthink this. The perfect investment does not exist. The perfect time does not exist. The only thing that matters is action. Your first investment may only be a few $100s, but its real value is priceless. It changes your identity. You are no longer a spectator. You are a participant. You have officially begun the journey from earning money to building wealth. The Freedom Builders Blueprint. Chapter 7. The Psychology of Wealth. Mastering your inner world. Building wealth is less about complex financial formulas and more about managing the 6 inches between your ears. Your financial success will be determined not by the performance of your investments, but by your ability to manage your own psychology during market swings, setbacks, and the slow march of compounding. This chapter provides the mental framework to develop the emotional resilience required for long-term wealth creation. Twin enemies of wealth: fear and greed. A very poor financial decision can be traced back to one of these 2 primal emotions. Understanding their triggers and developing defenses against them is your primary psychological task. Uno, taming the fear response. Fear manifests as panic selling during market downturns, paralysis that keeps you from investing, and an obsession with short-term losses over long-term growth. The reality of market cycles. Draw a chart of any major stock index over the past 100 years. You will see a line that moves up and to the right, but it is a jagged line filled with peaks and valleys. Downturns are not aberrations. They are features of the system. They are the price of admission for long-term growth. Your defense strategy. Focus on time, not timing. You cannot time the market, but you can control your time horizon. If you are investing for a goal 10+ years away, a 20% market drop this year is irrelevant to your end goal. It is merely a temporary sale on assets. Embrace dollar cost averaging. Your consistent, automated investment plan is your greatest weapon against fear. When markets are down, your fixed monthly investment buys more shares. This turns volatility into an advantage. Turn off the noise. Financial media profits from fear and excitement. Stop checking your portfolio daily. Unsubscribe from alarmist newsletters. Create a calm, informational environment. Those disarming the greed impulse. Greed manifests as chasing hot investments, taking on excessive risk for the promise of quick riches, and failing to take prudent profits. The seduction of the story. Greed is often fueled by compelling narratives about the next big thing. While some stories become reality like Amazon, most do not, like countless failed startups. The narrative is not an investment thesis. Your defense strategy. Stick to your plan. Your written investment plan is your anchor. When greed tempts you to abandon your diversified portfolio for a speculative bet, your plan brings you back to reality. Understand your circle of competence. Invest in what you understand. If you cannot explain how a company makes money in 2 simple sentences, it is outside your circle, and therefore a gamble, not an investment. Practice prudent selling. Have predefined rules for taking profits. For example, I will sell 10% of my position in a single stock if it grows to more than 5% of my total portfolio. This systematizes greed management. Building the 4 pillars of investor psychology. Cultivate these 4 mental traits to fortify yourself against emotional decisions. 1. Patience. The compound interest of character. Wealth building is a slow process. It is the result of small, consistent actions repeated over decades. Patience is the ability to trust the process even when you cannot see immediate results. It is understanding that the oak tree of your portfolio grows silently underground for years before it breaks into the open. 2. Discipline. The bridge between goals and accomplishment. Discipline is doing what you know you should do, even when you don't feel like it. It is automating your savings, sticking to your asset allocation, and rebalancing your portfolio according to your plan, not your mood. Discipline is what keeps you investing during a bear market when everyone else is selling. Trace. Rationality. Making decisions with your head, not your gut. Your gut feeling is the accumulated voice of your fears and biases. Rationality means making decisions based on data, logic, and a long-term plan. When the market crashes, the rational response is not sell everything. But is the long-term thesis for my investments still intact? If yes, this is an opportunity. 4. Emotional detachment. Separating your net worth from your portfolio's performance is not a report card on your intelligence or value as a person. A 20% market decline does not mean you are 20% less competent. By detaching your identity from your investments, you free yourself to make clear-headed decisions. You are not your portfolio. Practical mental models for better decisions. The 8th of October 10 rule. When faced with a fear or greed-based impulse, ask, how will I feel about this decision in 10 days, in 10 months, in 10 years? This forces a long-term perspective. Inversion. Instead of asking, how can I make more money? Ask, what could cause me to lose all my money? And then diligently work to avoid those pitfalls. The premortem. Before making a significant investment, imagine it fails spectacularly 1 year from now. Write down the story of why it failed. This helps you identify potential risks and blind spots in your logic before you commit capital. Conclusion. The inner game of wealth. Markets will test you. There will be periods of euphoric growth that make you feel like a genius, and periods of crushing decline that make you question your entire strategy. Your success will be determined by your ability to remain steady through both. Mastering your psychology is the true work of an investor. It is a continuous practice of self-awareness, discipline, and emotional regulation. By taming fear and greed, and by cultivating patience, discipline, rationality, and detachment, you build an internal fortress. This inner stability is the ultimate asset, the one that protects all the others. Your portfolio will reflect the world. Your psychology will determine whether you can navigate it successfully. The most important investment you will ever make is in mastering your own mind. Chapter 8. The Automatic Wealth Machine. Building your personalized system. Knowledge and psychology are the foundation, but a system is what builds wealth while you sleep. This chapter moves from being an active investor to becoming a strategic architect. You will design a automated financial system that methodically converts your income into wealth with minimal daily effort. This is the engine that will power your journey to financial freedom. The philosophy of automation. Making success inevitable. Willpower is a finite resource. Systems are relentless. By automating your finances, you remove the need for constant decision-making and emotional control. You design the machine, turn the key, and it works 24/7, immune to your moods, fears, or distractions. The goal is to make wealth accumulation a default outcome, not a daily struggle. The core components of your wealth machine. Your system will be built around 3 primary accounts, each with a distinct purpose. Uno, the command center, your checking account. This is the central hub where your income lands. Its only job is to distribute funds automatically to the other components. No spending should happen directly from this account beyond these automated transfers. Dos, the Freedom Fund, your brokerage. Investment account. This is your wealth-building engine. Its sole purpose is to hold your income-generating assets, your stocks, bonds. Money should flow in automatically and be invested automatically. Tres, the Fortress, your high-yield savings account. This is your security foundation. It holds your 3 to 6 month emergency fund and savings for large, predictable expenses. For example, car repairs, annual insurance premiums. This account protects your freedom fund from life's unexpected events. The 4-step automation blueprint. Follow this process to build your system in one afternoon. Step 1. Design your allocation plan before automating. You must know where the money is going. This is your personal investment policy statement. Define your percentages. Freedom Fund investing 20 to 30% of net income. The Fortress savings 5 to 10% until emergency fund is full. Then redirect this to investing life, expenses spending, the remaining 60 to 70%. Step 2. Set up the pipes. Automate transfers. In your bank's online bill pay system. Schedule automatic transfers for the day after your paycheck arrives. Transfer 1. Checking account gives Freedom Fund your investing percentage. Transfer 2. Checking account gives the Fortress your savings percentage. What remains in your checking account is your clear, guilt-free spending money. Step 3. Automate the investing. The critical second step. A common mistake is automating the transfer to your brokerage, but not the actual investment. The money must go from cash to assets. Set up automatic investments within your brokerage account, for example, Vanguard, Fidelity. Schedule a recurring purchase of your chosen index fund. For example, every 15th of the month, buy $500 of each. Use robo-advisors optional for ultimate simplicity. A robo-advisor like Betterment or Wealthfront can handle both steps 2 and 3 seamlessly. Step 4. Implement a quarterly tune-up. Full automation doesn't mean total neglect. Schedule a 30-minute review every 3 months. In this review, you will check progress. Are you sticking to your allocation? Rebalanced if needed, if one asset class has grown significantly beyond its target percentage. Sell a little and buy others to return to your desired allocation. This is often done automatically in target date funds or robo-advisors. Adjust contributions. As your income grows, increase your automated transfer amounts. Tie loading your system. 3. Investor profiles. Your machine should reflect your goals and risk tolerance. Uno, this simple path investor, this forget strategy. A single, low-cost target date fund. You choose the fund with a year closest to your expected retirement, for example, Vanguard Target Retirement 2050 Fund. The fund automatically handles diversification and rebalancing for you. Automation. Direct 100% of your Freedom Fund contributions to this one fund. Does the core satellite investor, the balanced builder strategy. A simple portfolio, like the 3-fund portfolio, total U.S. stock market, total international stock market, total bond market. This is your core, 80 to 90% of portfolio. Your satellite 10 to 20% can be for exploring other investments, like individual stocks or sector funds. Automation. Automate investments into your core funds. Allow manual, thoughtful decisions for the satellite portion. 3. The hands-free investor, the robo-pilot strategy. Delegate the entire process to a robo-advisor. You answer questions about your goals and risk tolerance, and the platform handles all allocation, investing, and rebalancing automatically. Automation. Simply automate one large transfer from your checking account to the robo-advisor platform. Advanced automation. Scaling your system as your wealth grows. Your system can become more sophisticated. Tax loss harvesting. Robo-advisors and some advanced platforms automatically sell securities at a loss to offset your taxes. Direct indexing. For large portfolios, this allows you to automatically own the individual stocks within an index, enabling more precise tax management. Conclusio. Your financial autopilot. Be building your automatic wealth machine. You elevate yourself from a laborer in your financial life to the foreman. You are no longer pushing the boulder up the hill every day. You have built a conveyor belt that carries it for you. T's system provides the ultimate peace of mind. You are no longer guessing, worrying, or reacting. You have a plan, and the plan is executing itself. You are free to live your life, focus on your career, and spend your mental energy on things you love, confident that in the background, your financial future is being built with relentless, automated efficiency. You have not just bought assets, you have built an engine that acquires them for you. This is the turning point where you stop working for your money, and your money truly begins working for you. Chapter 9. The Lifelong Investor. Building your financial intelligence. Financial freedom is not a destination you arrive at, but a skill you master through continuous learning. The market, the economy, and your own life are in constant flux. The investor who stops learning is like a sailor who stops reading the winds and currents. They will eventually drift off course or run aground. This chapter provides the framework and curriculum for your ongoing financial education, transforming you from a passive saver into a confident, knowledgeable capital allocator. The mindset of the lifelong investor. Adopt these 3 core principles for effective learning. 1. Intellectual humility. Acknowledge what you don't know. The financial world is vast and complex. The most successful investors are perpetual students, always curious and open to having their assumptions challenged. Those first principles thinking. Learn to break down complex financial products and strategies into their fundamental truths. What is the underlying asset? How does it generate value? What are the real risks? This protects you from being sold on slick marketing and empty narratives. 3. Process over outcome. Focus on making sound decisions based on the best information available, not on short-term results. A good decision can have a bad outcome due to random chance, and vice versa. Trust your process, not your latest win or loss. T-Core Curriculum for Financial Intelligence. Structure your learning across these 4 essential domains. 1. Foundational literacy. The T's is the basic language of finance. You must be fluent in these concepts. The time value of money. Understanding how money today is worth more than the same amount in the future. Compound interest. The mathematical engine of wealth, and how to make it work for you. Risk and return. The fundamental relationship between potential profit and potential loss. Asset allocation and diversification. Why to put all your eggs in one basket is the most important rule in investing. Inflation, the silent thief of purchasing power, and how to defend against it. Those market mechanics. Understanding the engine to navigate the system. You must know how it works, how the stock market functions. What is a share? What happens when you place a buy order? What are exchanges and brokers? Basic accounting. Learn to read a simple balance sheet and income statement. You don't need to be an accountant, but you should understand what assets, liabilities, revenue, and net income mean. Valuation basics. Grasp the core concepts behind metrics, like the price-to-earnings PE ratio. This helps you understand if the market is pricing a company high or low. Macroeconomic cycles. Understand the basic concepts of bull and bear markets, recessions, and economic expansions, not to time the market, but to maintain perspective. 3. Behavioral finance. Mastering your greatest liability. Your brain is your biggest investing obstacle. Study how psychology impacts decisions. Cognitive biases. Learn to identify your own biases, like confirmation bias, seeking information that confirms your beliefs. Los aversión, feeling the pain of loss more than the pleasure of gain. And recency bias, overweighting recent events. Emotional triggers. Recognize the feelings of fear, panic selling, and greed FOMO buying as they arise in you. Herd mentality. Understand the powerful pull of the crowd and how to resist it. 4. Advanced strategy. Building your toolkit, once. The foundations are solid. You can explore real estate analysis, how to evaluate a rental property cash-on-cash return, cap rate, tax-efficient investing, how to use retirement accounts and tax loss harvesting to keep more of your returns, alternative assets, an understanding of commodities, cryptocurrencies, and other non-traditional investments, building your learning system. A practical plan knowledge without a system for acquisition is useless. Implement this learning architecture, a daily dose, 15 to 30 minutes. Curate your inputs. Follow a few non-sensationalist financial news sources, for example, the Financial Times, Bloomberg. Unsubscribe from fear-mongering newsletters, podcasts and audiobooks. Consume expert interviews and deep dives. During your commute or workout, dose the weekly study, 1-2 hours. Deep dive reading. Read one chapter from a foundational investing book, for example, The Intelligent Investor, the Little Book of Common Sense Investing. Analyze a company. Pick a company you know and practice reading its annual report or a summary of its financials. 3. The quarterly review hafte. Assess your portfolio. This isn't about performance, but about alignment. Have your goals changed? Does your asset allocation still reflect your risk tolerance? Identify knowledge gaps. What confused you over the last quarter? Was it interest rates? A new type of ET? Make this your next learning priority. The Socratic method for investors. Learning through questioning. Donde? Hus absorb information passively. Engage with it critically by constantly asking, what is the underlying assumption here? What is the opposite point of view? How does this apply to my specific situation and goals? What is the evidence supporting this claim? Conclusión. Your knowledge compass. In a world of financial noise, hype, and complexity, your knowledge is your only reliable compass. It will guide you through market manias and panics, helping you distinguish between a genuine opportunity and a cleverly marketed trap. Commit to the identity of a lifelong learner. The money you invest in your financial education will yield the highest returns of any investment you will ever make. It is the one asset that cannot be taken from you, that compounds without risk, and that empowers every other financial decision you will make. You are not just building a portfolio. You are building the mind capable of stewarding it to greatness. Chapter 10. The final brick. Your legacy and the conclusion of the beginning. T's final chapter is not an end, but a commencement. You have moved from seeing your paycheck as a prize to be consumed to recognizing it as seed capital. You have audited and rewritten your financial mindset, adopted the strategic posture of an owner, and built an automated system that diligently converts your income into assets. You are no longer a passive passenger on your financial journey. You are the architect, the builder, and the steadfast captain of your ship. That journey recapped. From foundation to freedom. Look back at the path you have charted. Changed your mind. Chapters 1 to 3. You understood that wealth begins with a decision to see your resources differently. You identified and dismantled the limiting beliefs that formed your invisible prison and chose the empowering mindset of an owner. You built your engine chapters 4 to 6. You strategically leveraged your job as a launchpad, using it to fund your Freedom Fund, acquire knowledge, and build a network. You took the courageous first step of making your first investment, crossing the threshold from saver to investor. You fortified your system chapters 7 to 9. You mastered the inner game, learning to manage the twin enemies of fear and greed. You built an automatic wealth machine that runs on discipline, not emotion, and you committed to the path of lifelong learning, ensuring your decisions are informed by knowledge, not noise. These steps are not a one-time checklist, but a cyclical process of refinement. You will continually revisit these principles, each time with greater wisdom and a larger capital base. The final brick, building a legacy financial freedom, is often portrayed as a finish line. In truth, it is a gateway. Once your assets reliably cover your needs, you face the most important question. What is it all for? T's is where you move from building wealth to building a legacy. A legacy is not merely what you leave behind. It is the life you lead and the impact you make with your freedom. Your legacy can take many forms. A life of purpose and presence. The ultimate dividend of financial freedom is time. It is the ability to be fully present with your family, to pursue a passion without the pressure of monetization, to learn, to travel, and to grow as an individual. Philanthropic impact. With your own security assured, you can direct capital toward causes you care deeply about. Your investments can extend beyond your portfolio to support your community, fund research, or empower the next generation. Generational wisdom. The greatest inheritance you can pass on is not just financial capital, but human and intellectual capital. The knowledge, values, and principles of wealth building you have mastered. Teaching your heirs the Freedom Builders Blueprint is a legacy that can compound for generations. Entrepreneurial creation freedom provides the runway to build, not just for profit, but for purpose. You can start the business you always dreamed of, one that solves a problem or fills a need, creating value and opportunities for others. To conclusion of the beginning, you now hold the blueprint. The theories, strategies, and mindsets contained in these chapters are the tools, but a blueprint does not build a house. A map does not take the journey. That part is up to you. The world will continue to offer excuses: market downturns, economic uncertainty, personal setbacks. These are not roadblocks. They are tests of your resolve, and they are the very environments where the most dedicated builders separate themselves from the crowd. Your journey to financial freedom is a quiet, personal revolution. It is a daily commitment to making choices that your future self will thank you for. It is the courage to be different, to think long-term in a short-term world, and to take full responsibility for your financial destiny. The first brick has been laid. The foundation is set. The tools are in your hands. The path to freedom is built one intentional choice, one invested dollar, one mastered emotion at a time. Now, go build.